Welcome to the monthly roundup from Kepler Trust Intelligence, where Ryan, David, and I will be covering all the news in the investment trust world over the month of November. It's less a whistle stop tour and more a bumper edition this month, as we've heard from a number of our fund managers. Let's start off with the news. Ryan, what stories have caught your eye in November?
Thanks, Joe. So I saw a couple of interesting bits of news, primarily from the property sector in November. Firstly, TR Property brought its first physical asset in nearly 10 years, having spent a combined £19 million on a multi-let industrial estate in Bicester and another industrial unit in Northampton. For a bit of background, the Trust has a pan-European portfolio of REITs with up to 15% in direct UK property. The long-term track record of manager Marcus Fairmudge has been excellent. He's regularly outperformed both the real estate sector and the wider equity markets over the long term. However, the Trust, along with the property sector, has faced headwinds more recently. For a bit of context, the last year in which the Trust invested in physical assets, the UK was having an election that was seemingly decided by the inability to eat a bacon sandwich, and Donald Trump was a rank outsider in the Republican primaries. However, falling borrowing costs and an appetite for industrial have tempted the managers back in this year. The skill set of the manager is arguably the key supporter of this hybrid approach. They've repeatedly shown an ability to extract value via asset management with their direct investments, even with more challenging projects. And this approach has allowed them to stay connected to physical markets, which helps with the rest of their portfolio. This transaction allows them pure exposure to their favoured industrial theme, which helps differentiate the portfolio from peers in the wider sector. Now, sticking with property, Schroder Real Estate, or STRAY, announced results that showed first rise in property prices in nearly 2 years. As we said with TRY, the sector has been under significant pressure in the higher interest rate environment, but this is arguably another sign of pressure beginning to ease. When taking out the contribution of dividends, the NAV only rose by 1% in the half year to 30th of September, but this is at least positive and reverses some of the issues we've seen in previous years, including the much maligned Liz Truss era of politics. Now, this uplift was aided by yield compression as rates began to come down and rents remained resilient. Therefore, there are positive signs that this can continue for the future, especially with potential for more interest rate cuts to come. Later on, we'll be discussing Picton Properties results, which will shed further light on the performance of the property sector.
And sticking with news, we've seen some corporate activity announced in the month. Ryan, what's been happening with Miton UK MicroCap?
Yes, following a period of review, the board of Mini announced plans to wind up the trust. For background, the trust has an annual redemption facility that allows investors to request capital back. In 2024's edition, in October, around 40% of shareholders elected to receive a redemption, which would have led the trust to fall into a significantly smaller size. After engaging with shareholders, the board believed that a voluntary winding up proposal would be the best course of action. However, manager Gervais Williams continues to have a very loyal following. Many of those investors also appreciate the significantly undervalued opportunity within the UK microcap space. As such, they have made an option available to shareholders to roll over any holdings into an open-ended equivalent, meaning investors can continue to gain exposure to both the manager and the asset class in some guise. So while it is disappointing to be losing another trust from the market, especially another UK microcap trust, it hopefully will allow investors to find a new home in a slightly different vehicle.
And elsewhere, we've seen the return of some activist activity. So what's been happening this time?
Yes, November saw the re-emergence of Saba, having taken a stake in European Smaller Companies Trust. We previously mentioned activist activity surrounding Scottish Mortgage on a prior monthly roundup, but things have gone a little bit quiet since. However, activist activity has since re-emerged. We think it's worth noting at this point that we don't know what the strategy of an activist is, but going back to basics, most institutional investors buy shares with a view that they will go up. So that is most likely the hope of these approaches. To help inspire this, one typical move from the playbook of an activist is to allow their reputation to do the heavy lifting, hoping that their sheer presence on the shareholder register is enough to inspire the board into taking action or for other shareholders to act accordingly. Saba has done this in the past, often hedging its exposure of the trust through derivatives on the underlying portfolio. However, it's interesting that this is their first array into smaller companies, where the latter part of that strategy is much harder to do. So this could be a new approach for them. It's also important to provide a bit of context as well. This is not the first time activists have focused on the investment trust market, and the industry has continued to survive. It's likely a consequence of the wide discounts that we've seen across the board, but it is one of the trade-offs of having shareholders who are allowed to express their voices. We believe that taking an aggressive activist action will be very expensive and time-consuming, so that's likely to be a last resort for the likes of Saba, though it is certainly something to keep an eye on.
Thanks for that, Ryan. So moving on to results now, who's been reporting in November?
Thanks, Joe. So we saw quite a few results come out in November. One of those was Cordiant Digital Infrastructure. For a bit of background, Cord owns and operates a portfolio of assets linked to the digital world, such as towers that support telecoms, radio and TV, plus fibre optic cables and data centres. It announced its half-year results recently, which saw a NAV total return of 5.4%, putting the trust slightly ahead of its 9% annual target. The NAV uplift was primarily driven by the operational performance of its two largest holdings, Poland's Emitel and Czechia's CRA. Both firms benefited from inflation-linked contracts and revenue pickups, which contributed to the trust itself seeing aggregate earnings grow by an impressive 15.2% in the period. Other key news was on the debt side, which saw the restructuring of the trust debt facilities into a €200 million Eurobond facility. Not only has this reduced the near-term refinancing risk, there are no longer any repayments due until 2029, but has also increased the manager's liquidity position and giving them a strong base from which to operate the trust's successful buy, build, grow approach. Post-period end, the trust announced a new purchase of DCU, a Belgium data center business. This is arguably the area of the highest growth potential in the portfolio and helps diversify the portfolio further by asset class. Finally, there is the dividend picture. The trust announced a 2.1p interim dividend in line with the recently upgraded approach. This was covered 1.8 times by the trust's preferred adjusted fund flow from operations metric, so it is pretty well supported. All things in, a pretty good set of results from Cordiant. The full write-up is available on our website.
And I understand the Bailey Gifford European growth results also caught your eye, Ryan.
Yes, BGEU reported late in the month. The headlines for the results were dominated by the Northvolt situation. Now, this is a privately owned Swedish EV battery maker that filed for bankruptcy after experiencing the same challenges that have been seen across the motor industry of falling demand for EVs and increased competition from Chinese competitors. The managers also wrote off their stake in McMakler, a German real estate firm, both of which combined to detract about 6.5% from NAV, leading to the third consecutive year of NAV underperformance. However, what the headlines don't capture is that the underlying portfolio of public equities actually outperformed the market. Now, this is quite encouraging as the trust has a growth style, and this has been out of favour for a while, especially with higher inflation and interest rates. In the trust's interim results, it had shown tentative signs of recovery, though this has been totally overlooked by the wipeout of these two companies. Public equities make over 90% of the portfolio, so we believe it's quite encouraging for the future and perhaps an early sign that things might be starting to change for growth trusts, though the disappointment of these two write-downs has impacted an otherwise tentative recovery. The other key announcement from the results was the introduction of a tender offer in 2028, allowing for investors to have all of their money back at NAV should total returns fail to outperform the market in that time. Again, we think this is quite a bold statement for the trust, effectively saying that either we succeed or we return your money. Now, this looks pretty good from a governance perspective and is actually quite respectful of shareholders. So we really think that BGEU is going to be one to watch going forward. Now, that is enough from me. So it's time to hand over to you, Joe. We had interim results from Rockwood Strategic. What happened there?
Yes, another very strong set of results for Rockwood, which achieved a NAV total return of 23% in the 6 months to the end of September. And that compared to a decline in the FTSE AIM All Share Index of 0.4% and an increase in the FTSE Small Cap X Investment Trust Index of 13.2%. It was also my investment trust pick of 2024 in our KTI team competition, so I'm hoping it's going to fire me to victory. Crowing aside, it's great to see a poster child for the UK small cap sector, particularly when you consider that Rockwood has posted a substantial positive return over the last few years when the wider indices have been in negative territory. I wrote an article for our weekend edition a couple of weeks ago looking at funds that have outperformed the S&P over the last year, which, as we know, is a high hurdle. And Rockwood was one of these funds, which showcases the attractive valuations on offer in the UK small cap sector. Manager Richard Staveley runs a concentrated portfolio. It's been a tailwind for returns and focuses on self-help turnaround type situations where operational, strategic or management changes can help to unlock value. And Funding Circle and Filtronic have been particularly significant contributors to returns. Also worth mentioning that Rockwood has traded at a premium for most of this 6-month period, although the board has been active in managing this through a block listing programme. And for our final bit of results, I'd like to bring in our colleague David Brenchley, who's going to discuss the Picton property results. David, what's been going on with Picton?
Yeah, so we think that there was a lot to like in these results. The main kind of headline from Picton was a return to profit, which is obviously positive. So pre-tax profit was £11.5 million versus a £1.4 million loss the last time around. That was driven by capital income and rental growth, so all good things. A well-covered dividend, reducing debt. And yeah, we think there was a lot to like I said, and on a 27% discount. We think that potentially property is looking up. We saw a few other kind of similar REITs, land securities, etc., reporting similar increases in valuation.
And sticking with David, he'll talk us through the most bought trust for the month of November.
A little bit of change here. Obviously, I think Scottish Mortgage is always a very popular one with retail investors. Certainly, we've seen some kind of more positive results for them recently. JP Morgan Global Growth and Income's also, kind of perennially a favourite among income investors, and Greencoat UK Wind as well. So the two interesting ones, new entrants into the top 5 are F&C Investment Trust, which is, again, that kind of global growth investment trust, the oldest investment trust around. So, people know that. JP Morgan American was the other one, which potentially unsurprising considering kind of what we saw in November, re-election of Donald Trump being a good catalyst for US shares. And we saw a lot of kind of buying activity by UK retail investors in US stocks. So AJ Bell, the investment platform, said that they saw triple the average value of buys and sells in the US and more than twice the average daily trade volume in US shares the day after the US election. So clearly people are trying to figure out who's going to be the winners and the losers from Trump's second term.
Thank you for that, David. Now, Joe, back to you. You welcome Jasmine Yeoh, the manager of the Ruffer investment company, as our guest on our new Market Matters show. Given that Ruffer invests across equities, bonds and precious metals, what insights did Jasmine share?
Yeah, definitely worth a listen. As you say, Ruffer invests across a range of asset classes, but running through a few of Jasmine's thoughts, she contrasted Europe and the US quite amusingly by talking about SpaceX catching rockets with chopsticks while the EU is making us keep the caps attached to our plastic bottles. But in terms of US equities, valuations do remain high, meaning that longer-term returns don't look particularly attractive. And Jasmine feels it's a fragile market which is vulnerable to drawdown risk if something upsets a soft landing narrative. She also had some very interesting thoughts on the direction of policy under a Trump administration and that combination of political and economic uncertainty with a fully valued market backdrop. So she sees a wide range of potential outcomes. She also talked about US equities potentially having borrowed future returns, which is an interesting thought. In terms of geographies that do offer an attractive risk-reward profile, she felt the UK and China stand out on both of those. In terms of the UK, as we know, sentiment has been poor, improved briefly, started to gather a little bit of pace post the election, but has retracted after the budget. On the fundamentals, Jasmine still feels it looks reasonable, and if the fiscal impulse can drive growth at a time when inflation is moderating, then clearly that's going to be a more supportive backdrop. Turning to China, which Ruffer has previously referred to as the ugliest duckling in a portfolio of ugly ducklings, they see some swan-like characteristics for China given low valuations and poor sentiment for wider emerging markets. And that means you can buy global leaders across a variety of sectors such as tech at a fraction of the valuation of non-Chinese competitors. Jasmine feels the stimulus has put a floor in equity markets and provides asymmetry, but it's not about a shift in the fundamentals per se or the stimulus really being sufficient to fix their economy, but it's more about a shift in sentiment.
Thanks, Joe. And elsewhere, we've heard a lot about the game-changing obesity drugs this year. What did Elsa and Marek, managers of the International Biotech Trust, have to say about their impact on the biotech sector?
Yeah, I'd highly recommend listening to the whole podcast. It's really interesting to hear their thoughts on a sector that's dominated the headlines, as you've said. Starting off with obesity drugs, Elsa pointed out they tend to be perceived as new therapies, whereas actually they've been used for decades for diabetes. And yes, they've been a game changer. originally because they were seen as aesthetically advantageous, whereas the clinical data has actually shown a huge reduction in cardiovascular events such as strokes and heart attacks. In terms of market potential, Elsa described it as monstrous. So if all obese patients in America were treated with these drugs at the current price, it will cost the same as the whole of the pharmaceutical branded budget, which is fairly mind-blowing. She spoke about scope for innovation, including trying to address side effects such as nausea and loss of muscle mass. We also asked Elsa and Merrick whether Eli Lilly and Novo Nordisk are so far ahead in terms of their obesity drugs that others can't catch up. Elsa mentioned that CapEx is a significant barrier, with both companies having invested something like $60 billion in manufacturing plants, but actually supply still can't keep up with demand, and some of the new approaches may be quicker and cheaper to manufacture. She feels there's a long way to go with around 10 years of IP life, so it doesn't necessarily mean that other companies won't get a look in. Moving on to valuation, they felt that Eli Lilly and Novo Nordisk have taken some of the capital out of the broader sector, so valuations remain relatively depressed and on an absolute basis at similar levels to 5 years ago. And as a result, they're seeing some very attractive valuations in the small and mid-cap space. Merrick also pointed to 25% of the companies in the MBI index being valued below their cash position, which is rare. Now the election uncertainty has been removed, they expect to see valuations and M&A increase. And they pointed out that last time Trump was in power, the biotech sector rose by 40%. And while biotech remains sensitive to interest rates, strong revenue growth should be a longer-term driver of returns.
Thanks, Jo. And you also welcomed Chris Berrier, manager of Brown Advisory US Smaller Companies, on our Trust Issues podcast. What were some of the highlights from Chris?
Yes, BAS's aim is to drive double-digit returns while managing risk, which is important in a sector such as US small caps. He feels the sector has suffered due to the prolific growth of the Magnificent Seven, as we know, which he described as sucking the oxygen out of the room because investors would rather own what they know and what they deem to be great than gravitate down to the unknown and invest in something that could be great. Christopher also spoke about the AI excitement manifesting itself in making a cohort of relatively unsexy US small caps become much more valuable in the long run. So we're seeing older economy companies building the infrastructure for data centers and capitalizing on the billions of dollars of capex spending by the US hyperscalers. He very much saw these as long-haul themes that can drive long-term returns at the right valuations. As we know, Americans often love a sporting analogy, and Christopher feels we're in the later innings of the game in terms of large cap leadership due to the concentration of returns. And when capital goes elsewhere, it could go into a variety of different sectors. But Christopher extolled the merits of having a few chips elsewhere on the table.
And speaking about looking elsewhere on the table, you also spoke to Richard Sennitt, manager of the Schroder Asia Pacific Trust. What topics did Richard discuss?
Yes, indeed. Starting off with China, Richard felt the recent stimulus announcements were undoubtedly positive, but the market moved up pretty swiftly on the back of those and is trading more in the middle of its historic trading range rather than towards the bottom. Richard, I think, would like to see more announcements on the stimulus side focused on improving consumption and mobilising household savings. SDP, as we know, has been consistently underweight China over time, partly due to the structural challenge of rebalancing to a more consumption-led economy. But that said, Richard has been adding to names where he's seen value. Now, we've seen a lot of talk in the press about tariffs in the light of Trump's victory, and that does have implications for the region, particularly in terms of the competitiveness of Chinese exports to the US. But Richard feels that could help some of the other countries in Asia who should enjoy lower tariffs. He also spoke about the potential inflationary impact of Trump's budget, and the higher for longer interest rates could be a headwind for the region, but a positive for the financial sector where SDP is overweight. So swings and roundabouts on that front. Overall, he feels that Asia will continue to offer strong growth drivers, not only in terms of being manufactured to the world, but also moving up the value add spectrum, for example, with world-class IT companies. There's also domestic consumption plus increased financialization of the industries in Southeast Asia, which should broaden the investment horizon further for active stock pickers. Before we move off the topic of podcasts, you can find all of these on YouTube, Spotify, or Apple Podcasts under Trust Issues.
And just to flag, while we are still on SDP, they recently released results for which we've prepared a results analysis piece for those who wish to read more. Now, moving on to events, with inflation easing and interest rates on a downward path, the theme of this week's event was a new era for equity income. Richard Aston, manager of the CC Japan Income and Growth, or CCJI, started proceedings. What were some of the key takeaways from his webinar?
Yes, Richard provided us with a deep dive into Japanese equities. He started off by talking about the continued evolution of corporate governance reforms to raise awareness of the cost of capital, particularly the recent Tokyo Stock Exchange initiative to put pressure on those companies trading below book value, which is around half of companies. Richard also spoke about the attractive investment universe in Japan, which includes global market leaders well positioned to benefit from friendshoring. He also pointed to the strong income potential in Japan, with payout ratios below the US and Europe and high dividend cover, which provided protection during the pandemic. And the trust very much looks to capitalise on the continued inefficiencies in Japanese equities, including half of listed companies receiving no sell-side analyst coverage, which supports alpha generation for active managers.
And David, who else spoke at the event?
Yeah, so the other two were more focused on the UK. So we had Thomas Moore at Aberdeen Equity Income and Julian Kane of CT UK Capital and Income. So Thomas Moore kind of talked through his three-pronged approach to equity income, which is looking for companies with high dividend yields, good dividend growth, and those with the potential for valuation re-rating. Interestingly, he named Imperial Brands, the cigarette maker, as one that kind of hit all three, noting that the dividend yield at the moment is 5.8%. That dividend's up 10% since 2021, and shares have more than doubled over the past year. So tapping into some good trends then. And Julian Kane, I mean, he talked about, I guess, what we've all been talking about with UK shares, and that's just the valuation opportunity. And he kind of pointed out how historically there's a very close correlation between the price you pay, particularly for a certain stock market, and the kind of returns you get over the next 10 years. And I think the hope there is that the UK is kind of in a sweet spot at the moment. And hopefully, while confidence is low at the moment, there are some good kind of fundamentals. So if that confidence can kind of increase, potentially the UK looks in an interesting place.
And that's it for this month's bumper edition on Investment Trust News. If you'd like to find out more on any of the topics we've covered today, head over to the Kepler Trust Intelligence website, and we hope you join us again soon.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.